The IRS plans to use about half of its new $80 billion in funding to hire more agents and crack down on tax cheats.
Republicans probably don't want this to necessarily be an election about Donald Trump or even about the Republican Party and its direction. They want it to be about how things in the country are going, because they're winning those voters who say that things are going badly. And one of the big things on this, one of the big drivers of this...
Let me guess, economy?
The economy.
The U.S. political space is agog, as this is the midterm election season. Many members of the Congress would be fighting to survive. The presidency would be trying to throw in as many economic policies before the fast-closing window slams shut. This is going to be a very volatile period because it is a battle for policies that would affect each and every American, and a key defining moment for the Joe Biden presidency. Any wise investor would be paying close attention now, and that is exactly why we would be featuring Kevin O'Leary's interview on the huge significance of the U.S. midterm elections, on the economy, and hence on investments. Welcome to another episode of Wealth Supremacy. Subscribe and hit that like button. We appreciate it very much. Now, listen to what the investment juggernaut has to say.
I have a slightly different view of what is occurring here. I've lived through many cycles, obviously, as everybody has on this call. What I find intriguing about the nature of this correction, if you want to call it that, or the potential of a recession, is that it is in the foreshadow and then the shadow of $6 trillion worth of printing. And so you think about what occurred during the pandemic, which is unprecedented in any economy's history, to take that much and print it in basically 30 months and not to expect inflation. Well, of course, that's why we have what we have right now, a 40-year, new high in inflation. But at the same time, if you could figure out the printing presses were going to stop, you would be forecasting a new leg up. And here's my thinking on this. There's two bills right now in front of Congress. And so one is a watered-down version of Build Back Better. They're calling it anti-inflation, what everybody knows is a joke. This is very inflationary, but it's a spend over 10 years. So that's one attribute of more printing, which would maintain an inflationary stance and, of course, keep the Fed raising rates, which is not good for equities. And then there's this interesting situation in the CHIP bill, where we're going to spend billions of dollars. It's, again, free money from a helicopter going into the Midwest to try and catch up with what's happened in our lack of ability to manufacture semiconductors. Now, cut it to what it is. It means that management, the Intels of the world, the AMDs, they made a mistake. They moved all their production offshore decades ago. Took the U.S. down from 32% of manufacturing down to less than 10. Now they got to bring it home. We're going to print money to make that happen. That also is inflationary.
In this interview, Kevin makes a strong argument for the correlation between politics, policies, and the economy. He starts off concerned about the volume of money the United States has printed in the past 30 months, which is incredible. Some sources putting the figure as high as 80% of money in circulation today was printed in from 2020. In 2020 alone, newly created dollars amounted to a whopping $3.5 trillion, which were used to back government securities and treasury bills. This was to help cushion the economic stress caused by the COVID-19 pandemic. Joe Biden's government aims to revive the U.S. manufacturing industry, which has been receding over the years, causing huge trade deficits that are not good for the U.S. economy. 2022 started with a 9.4% increase in the U.S. trade deficit, amounting to $89.7 billion. Kevin O'Leary believes the government would have to print more money to be able to boost local manufacturing.
You've got a situation now where normally any incumbent, you don't have to get into politics, doesn't matter. It doesn't matter what party's in power, they lose seats in the midterm. That happens 100% of the time. There's fatigue, people are tired, they want to make changes, and it's happening at a regional level. This time, though, in my view, there's at least a 50-50 chance that both the House and the Senate flip to the other party. I don't even want to get into politics, but the point is there's a lot of unhappy campers in America today based on inflation around food and energy. They're really pissed. And so when that happens, and it's so close, it's November 8th, this is the good news for investors. After that night, there will be total gridlock in Washington for the next 2 years. There will not be a single piece of legislation passed. It will be impossible to get anything done, and that's a great thing. That's a wonderful thing because markets love Washington gridlock.
Kevin O'Leary believes that there's a 50-50 chance that the Congress that is currently majority Democrats is likely to swing with the midterm elections this November 8, because many electorates are not happy with the economy, particularly because of the extremely high inflation we have witnessed, which has reached unprecedented historic heights this year. He is excited at the prospect of this flip happening because it would lead to a Washington gridlock, which he says is good for the equity market. Raoul Paul asks, why is it that at any time there is a Washington gridlock, equities seem to perform better? Let's hear Kevin's response.
Kevin, why is that? Why? Because I've noticed this in the past. As soon as there's a split Senate, House, all of this stuff, it's good for equities. Why?
Because take, for example, what's happening right now in this Build Back Better inflation bill. They're adding a 1% tax to stock buybacks. Why would you do that? Why would you do that? Then they put a 15% minimum corporate tax in the U.S., an idea floated by Yellen all around the world. Nobody followed her. Now the U.S. is less competitive. The politicians damage bull markets. They've never run businesses. They have no idea what they're doing. They're just throwing this stuff out there to raise money. I don't want to be a cynic, but it's a fact. They have no idea. And so they put these crazy policies in place. The more you keep chipping away with stupid policy, the more damage you do long term to your economy. Now, this 15% minimum tax does not help equities. It doesn't. It's just going to have companies contort and try and figure out how to get around it. Bottom line. The IRS, 88,000 more agents, that's just going to hassle small businesses in America. Not a good thing. So bad policy. The whole point is when you have a situation where Washington can move policy, more than 50% of it is bad policy. When you have total gridlock, they can't do anything. They can't damage anything. Listen, it's important to have government for many different services, but not for making economic policy. They're really bad at it. So that's why I point out, once you shut down the policy machine, markets get to move back up.
We should expect the government to pump out a lot of policies from now till November 8, aimed at placating the electorates to maintain the government's popularity going into the polls. We're already seeing a lot of these corrective measures coming online. Unfortunately, this also comes with a lot of market skepticism. But the good news is, there would most likely be Washington gridlock after the elections, and this is always good for the equity market. Washington gridlock means the government is unable to bring new disruptive policies on board, translating to stability in the economy. Kevin argues that most of the time, new policies are damaging to bull markets, because the focus of government is not investments, but to quickly raise money. We see this play out in policies such as the 15% minimum tax policy. IRS planned to recruit thousands of agents, which O'Leary says would only hawk down on small businesses. NASDAQ doesn't agree with Kevin O'Leary that increased taxes reduce the potency of the equity market. NASDAQ actually says their data shows improvement in the stocks every time there's an increase in taxation. Do you agree with Kevin on his assertions, or do you think these policies are actually favorable to investors? Let's hear your take on this matter.